recognize valid, high-quality order blocks carries serious risk and can lead to major losses. Order blocks, though frequently underestimated, are crucial in spotting high-probability trading setups and form a core element in smart money trading strategies. Yet, many traders find it challenging to pinpoint legitimate, high-quality order blocks, which can jeopardize their positions. In today's advanced episode, we'll be exploring different types of candlestick order blocks and the trading strategies built around them. Plus, we'll analyze the price actions linked to order blocks that you're likely to see in the market. But there's more. We'll also cover the essential criteria and rules that turn an order block into a high-probability trade. So traders, if this sounds valuable to you, drop a thumbs up to show your support, and hit subscribe if you're new here. Catch you right after the intro. Welcome back, traders. Let's get started by diving deep into the details of order blocks and how do we define an order block. In a bearish scenario, an order block refers to the zone of the last bullish candle preceding a strong and significant downward move that produces a valid break of structure. Likewise, in a bullish scenario, it denotes the area of the last bearish candle before a sharp and substantial upward move that creates a valid bullish break of structure. Now, let's explore what's the market psychology behind these zones. The idea behind treating these zones as potential reversal points stems from the belief that they mark areas of market manipulation occurring right before a major price shift. Traders consider these zones to be regions where significant buy or sell orders have been placed. By incorporating these zones into our trading strategies, we can potentially capitalize on the strong likelihood of a price reversal or directional change when the market returns to these levels. Now, let's move on to the next topic and explore how to spot a valid order block using candlestick patterns, along with the different scenarios you might come across when identifying candlestick-based order blocks on the chart. In a bullish setup, a candlestick-based order block is identified as the final bearish candle before the price begins a strong upward surge. This candle often dips below or successfully sweeps the liquidity from the lowest point of the preceding candle. For instance, in the bullish diagram, we highlight this red candle as a valid order block. It marks the last bearish candle prior to a sharp upward move, having breached the previous candle's low and cleared its liquidity. Likewise, in a bearish setup, a candlestick-based order block represents the last bullish candle before the price starts to decline sharply. This candle usually moves above or sweeps the liquidity from the highest point of the prior candle. Now, let's dive into the key criteria and rules to consider when identifying valid order blocks in the market, and learn how we can leverage them to our advantage. It's important to understand that for an order block to be confirmed and considered valid, the price must first sweep the liquidity above or below the prior candle. Secondly, the price should leave behind inefficiency and create an imbalance near the order block zone. If there's no clear imbalance between the following candles, the order block in question cannot be deemed valid. Rule number 3. The order block must be unmitigated. Order blocks are typically viewed as one-time use zones, meaning we concentrate on the trading opportunity the first time price enters the block. Once it has been mitigated, it's no longer treated as a key area for future trade setups. Rule number 4 highlights that a high-quality order block must result in a break of structure or a shift in market character. These two elements, break of structure and change of character, are critical indicators that help determine whether the market will maintain its current trend or reverse direction. This reinforces our understanding of how order blocks function. Let's go through additional examples. Take a look at a series of bullish candles, as illustrated. You'll notice the market was trending downward until a small bullish candle appeared, just before the price surged upward with 3 strong green candles. This smaller bullish candle hit its lowest point here, and also swept the liquidity beneath the prior candle. As stated earlier, without a distinct imbalance in the candles that follow, we cannot consider the order block as valid. Observing this 3-candle formation, the upper wick of the first and the lower wick of the third do not intersect the body of the middle candle. This creates a clear gap, signifying an imbalance. Because the requirements for a valid order block are fulfilled in this case, this candle is classified as a valid order block. Now, shifting slightly higher, we observe another sharp upward price movement. The red candle here marks the final bearish candle formed before the strong bullish impulse. This candle also swept the liquidity below the low of the previous bearish candle. Additionally, there's a visible gap within these 3 consecutive candles, satisfying all the criteria for a valid order block. Hence, this candle can now be regarded as a valid order block with reversal potential if price returns to mitigate it. On the other hand, observe this bearish candle, which was the last bearish candle before the price moved upward again. However, this particular candle does not meet the criteria for a valid order block since it failed to sweep the low of the preceding candle. Let's explore further examples. Refer to the second diagram showcasing another candle sequence. Once again, the market takes out the low of the previous candle, effectively sweeping liquidity, this time through a bearish inverted hammer. This gives us a potential valid order block candidate. However, there's a lack of clear imbalance in the three-candle structure, and the order block is mitigated by the upper wick of the following bullish candle. As a result, this order block cannot be classified as valid since it does not fulfill the essential conditions required to be a legitimate order block. Hence, it cannot serve as a reliable demand zone. When we encounter similar cases, where the liquidity sweep occurs but either the block gets mitigated or fails to produce imbalance, we instead select the next candle as the valid order block. In this example, we identify the bullish candle as the valid order block instead of the earlier bearish one. This choice is grounded in the creation of a noticeable imbalance immediately after this bullish candle. Looking slightly further up, we again observe price taking out the low of the prior candle through a bullish move, just before a sharp rally. But in this situation, there is no clear imbalance, and the order block is again mitigated by the upper wick of the next candle. Consequently, it cannot be deemed a valid order block or used as a demand zone. In the next movement, we notice another strong upward push. This red candle marks the last bearish candle before the price aggressively surges upward. It's clear that this candle sweeps the liquidity below the previous bullish candle. Moreover, it creates a clean imbalance within the three-candle sequence, and there is no sign of mitigation. Since all conditions are satisfied, this candle qualifies as a valid order block. These principles apply to bearish trends just as well. It's also essential to remember that these strategies can be adapted to various timeframes and any chart based on price action. Now let's move on to a live chart to apply everything we've discussed in this session, and observe how to accurately identify valid order blocks in real market conditions. On the screen, we're observing the EUR15 United States dollars minute chart. It's clear that the market is currently in an uptrend. Upon examining price action closely, we notice that the price has established a bullish break of structure, BOSS, by decisively breaking and closing above a significant high. Once a BOSS is confirmed, our primary focus shifts to locating the order blocks that correlate with this structural break. Let's start by analyzing this red bearish candle at the extreme end of the move, which marks the last bearish activity before the price surged upward. While it does take out the liquidity beneath the previous candle, upon further inspection, it's clear this candle is mitigated by the small upper wick of the following bullish candle. Due to this mitigation, it cannot be classified as a valid order block. Shifting slightly higher, we find another bearish candle that also precedes a strong bullish movement. This candle effectively sweeps the low of its previous counterpart. But again, after marking it, we notice that the following bullish candle's wick mitigates it, making it invalid. As per our criteria, if the original order block is mitigated, we shift our attention to the next candle in the sequence. This time, the next candle does qualify, becoming our valid order block. Moving forward, we identify another significant bullish impulse. The bearish candle preceding this push again sweeps liquidity but is followed by a mitigation wick on the third candle in the sequence. Just like before, we move to the next candle. However, this too is mitigated. We finally identify the red hammer that follows as our valid order block. Yet upon review, we see that while price does tap into it and shows a minor reaction, it ultimately breaks below. This failure often stems from premature entries. It's critical to wait for price to clear inducement levels before taking trades. This concept was explained in detail in our previous sessions. Be sure to review those for deeper context. As we progress, the price does eventually tap into our valid order block, reacts positively, and begins to push higher. This is a textbook example of a high probability long entry. Later, we observe a change of character, CHOCH, as the market breaks below a key structural point. Once a CHOCH is identified, our strategy shifts. We must now wait for the market to take out the inducement level before acting. In this example, the most recent low serves as that internal level. Once that's taken, we anticipate price returning to a valid order block. In this scenario, this red bearish candle, the last one before a significant bullish drive, becomes our new focus. It sweeps liquidity and is followed by a clear imbalance. Therefore, this candle is a valid order block. If price revisits this level, it could present a strong long entry opportunity. Traders, we've now laid a strong foundation in identifying key order blocks that consistently appear across real price charts. With this understanding in place, it's time to move forward and integrate this knowledge into actionable trade execution. In this next section, we'll dive into the entry models that align with order block strategies. These models are designed to give structure to your trading plan and enhance your precision when entering the market. There are 4 primary entry methods based on order blocks. Choosing the right entry approach varies with multiple market conditions, including 1. Price action dynamics, 2. Trading sessions, 3. Market volatility, and overall momentum. By evaluating these factors carefully, traders can determine which entry type is most appropriate for the scenario at hand. Implementing the right entry strategy not only increases the probability of a successful trade but also helps in managing risk and improving consistency in your trading results. The first entry method utilizes the wick for trade execution. In this approach, once a valid order block is identified, we position our buy/sell order directly on the wick. For a sell setup, the stop loss is placed a spread size above the order block's upper wick, offering a more generous stop loss margin. This setup offers a larger stop loss margin, which can directly impact the reward-to-risk ratio by reducing it. However, using this type of entry increases the likelihood of your order being triggered, as the price may only tap the wick before moving in your anticipated direction. The second entry type is known as the body entry. In this method, once a valid order block is identified, the trade is executed based on the body of the candle. For sell positions, the stop loss is placed a spread size above the high of the wick. This approach generally provides a more favorable reward-to-risk ratio, making it ideal for traders aiming for maximum efficiency in their setups. Compared to the previous entry type, the body entry offers a tighter stop loss, which enhances the overall reward-to-risk ratio. This makes it a more efficient strategy for traders looking to maximize returns while maintaining controlled risk. This approach carries a slightly higher level of risk, as there is a possibility that the price may only tap the wick of the order block and then move in the anticipated direction, without activating your buy or sell order. As a result, there's a chance of missing out on a potentially profitable trading opportunity. Let's move on to the third entry type, my personal favorite and the one I use most frequently in my trading plan. This method involves placing the entry at the midpoint of the order block zone. Once a valid order block is identified, and in the case of a bearish setup, the stop loss is placed a spread size above the highest point of the order block. This entry strategy offers a reward-to-risk ratio that is at least twice as favorable compared to the standard entry types previously discussed. The improved ratio results from a more refined entry point and a tighter stop loss range. That's exactly why this approach stands out as my preferred method. It's designed to potentially increase profitability while maintaining efficient risk management. The fourth entry type involves executing the trade based on the body of the order block candle. Once a valid order block is identified, the entry is placed accordingly, and for sell positions, the stop loss is set just at the high wick of the order block. This method is undeniably riskier, as the stop loss lies within the boundaries of the order block itself. If the price fully retraces the order block before reversing, it may trigger your stop loss prematurely. Therefore, it's crucial to understand the elevated risk tied to this strategy and evaluate whether it aligns with your overall trading plan. That's it, traders. Thank you for watching this video. I hope you found the breakdown of order block entries both informative and actionable. If you haven't already, hit that subscribe button and turn on notifications so you never miss an upload. We'd love to hear from you. Drop a comment below with your thoughts, feedback, or suggestions for topics you'd like us to cover in upcoming episodes. We appreciate your support, and we'll see you in the next video.